And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning. It's the Hump Day edition of The Real Investment Show. I'm your host, Lance Roberts. Glad you could join me this morning. Man, what a great evening last night.
Mm-hmm.
Did you get outside?
We did. We had our HOA meeting.
Oh, that's no fun.
Outside, next to the landscape.
So basically, you're telling me but you're the people I hate.
I'm not on the board any longer.
You're just,
I'm actually PO'd at them because they're going to raise our rate next year.
Of course they are.
You know, and there's no reason for it because in the budget there's plenty of room.
Of course,
plenty of
but
surplus.
we need to raise it.
Yeah,
right. This is. And I don't want to get into the whole property tax discussion.
Nope. That whole other ball of wax.
Exactly. But no, so my wife.
But thanks for asking.
Yeah, no. So last night was beautiful, right? So
yes.
We had the doors and windows open, and so my wife and I and the kids, there's a little restaurant down the street from our house.
Mm-hmm.
It's probably a quarter mile or so from the house.
Yeah.
So we walked down there to watch the Astros play.
I'm sorry.
And so we went down and had dinner. And, well, thanks for ruining my punchline here.
No.
But
Not at all.
But, no, we walked down to have dinner to watch the game. And so we were watching the game, and it didn't turn out well. And so, but I have to ask Russell this morning. Should I be worried about that $200,000 you put down on the Astros to win the series?
You know, I'm a little worried about this now.
I mean,
and what about that furniture purchase?
That was mine. I was going to ask him because I bought the bed. So
did you really?
No, but I was close. I was close because I need a new bed. I was like really close to doing it after you and I talked the other day. So what do they have to do? They've got to win tonight, but they play here in Houston, right?
They do play here in Houston tomorrow night.
And who are they pitching? Because hopefully it's not
gonna be
Verlander
Garrett
again.
Cole.
Because Verlander was struggling last night.
He was, but didn't help. The Astros didn't hit either.
Yeah, true. So, how important is this game on Friday?
It's everything. Everything.
So that's
you don't win this game. You don't with the best record in Major League Baseball. It's complete utter failure in 2019 season if you don't get out of this series.
Yeah. And that's my worry there.
Yeah.
And I think I may have jinxed the whole thing when I was teasing, Russell the other day about making his $200,000 bet in Vegas on Astros to win it all.
Yeah.
I may have jinxed it. So I apologize, Russell, if that turns out to be the case.
All right, so you're forgiven.
Thank you. So, yeah.
Ball fans are almost as superstitious as
I think
investors.
the worst. I think baseball fans are more superstitious than probably investors or football fans or just about anybody else. Except for Russell, because Russell has this terrible towel every football game with the Steelers. Am I wrong?
You are not wrong.
There you go.
Hey, but he's loyal to a fault.
Yes, absolutely.
Yeah.
Tell you what, I was watching Terry Bradshaw the other day.
Yeah.
On Sports Wrap, and it's amazing that he's getting up there in years now.
Yeah.
But it's amazing how well he's done for himself.
I saw Troy Aikman doing some kind of commentary over the weekend too, and they're holding up well.
Yeah, they're doing.
Can't walk, but they're holding up well.
That's why they're always seated.
Have to roll them in the set on a wheelchair.
They're always seated. Anyway, all right. Look, we got lots of stuff to get into this morning. It's going to be another beautiful day, by the way. So get outside and enjoy it. It was well worth getting outside yesterday for a bit. Spent some time with the family. This morning, futures are pointing up here a little bit. Guess why? Well, China said that they might be open to a partial trade deal. So, this is just back and forth every day. Yesterday, the market sell off 45 points because we don't have a trade deal. Nobody's agreeing to a broad trade deal. And now China's open to a partial trade deal. Now, the reason I bring this up is because this is exactly what we've been talking about now for the last ad nauseum 4 months. But 2 weeks ago in our newsletter, we wrote the whole thing about a whole a dissertation basically on why Trump will be open to a partial trade deal and why we will likely get a partial trade deal done. Those negotiations start tomorrow, right? So all this stuff that's been going on with trade between the White House and China over the course of the last few days, it's all been posturing. We've been talking about this. But if you go to our website, realinvestmentadvice.com, click on the newsletter link and go to not this past weekend's, but the weekend before, we have an article on Trump and the trade war and getting a trade deal done. And this is important because of two things. One, we've got the election coming up, and we've talked about this, that Trump needs to get this kind of trade. He needs a win, right? He needs to get a win kind of under his belt. But also, too, importantly, besides just getting a win, he also just needs to get this off the front page. This back and forth between China is weighing on Rust Belt farmers, in particular, agricultural farmers, who have been under a lot of pressure because of these tariffs. And those are the states that he needs to win. Now, it's ironic. Yesterday, Hillary Clinton. Did you see this yesterday?
I heard about this.
Hillary Clinton rocketed to number 3. So we were talking about Russell going to Vegas and betting, right? So in Vegas, you can bet on the outcome of elections. Really. Yesterday, Hillary Clinton rocketed to number 3 in the betting tab. She is behind Elizabeth Warren, and Elizabeth Warren is number 1 right now. She is favored to win over Joe Biden, and Hillary Clinton is now number 3. So now what was interesting yesterday, of course, is that Donald Trump tweeted out commenting about this fact, and Hillary Clinton tweeted back. The great thing about Twitter is that you can get a good little battle going on.
Oh, yeah.
Hillary Clinton tweeted back at Donald Trump. She says, "Don't make me come do your job." So this
Really?
really.
Your job?
Don't make me come do your job.
So she's admitting he is the president.
Yes.
There you go.
There you go.
Legitimacy.
Exactly. He has been legitimized. But this is about to get ramped up here. But my point about this is that he needs to get this deal done, a partial deal. And a partial deal isn't going to be much. And there's going to be a lot of kind of pushback on the president potentially from his supporting base about not getting a whole deal done. But the conversation will be, the pitch will be, we got a partial deal done so we can get the tariffs off the table and get us in a good position with China, and we're going to negotiate the rest of the deal down the road. And that gets this off the slate going into the 2020 election so we can focus on the re-election campaign. So that's what all this stuff is kind of lining up to what we suggested a couple of weeks ago, that this is going to be the case. So today's announcement by China, they're open to a partial trade deal, now opens that gate for Trump to come in to start negotiating tomorrow on getting a partial deal done. They've already agreed to about 80% of what Trump wants. It's just that 20% that they won't agree to. So getting a partial deal done on the 80, this is going to be really easy for him to get accomplished and get done. If he's smart about it, get it done, get it out of the way before the election. Be right back. Danny Ratliff joining me. Don't go away. And welcome back to the show. It's morning 6:18. Danny Ratliff, certified financial planner, joining me this morning. A few things to get into. It's that time of the year also.
It is that time of the year.
Yeah, open enrollment.
Oh, I was thinking baseball playoffs. which
we were just talking about that, by the way.
I know.
I know you were listening to the show, weren't you?
Which you're banned from talking about or watching the Astros anymore. Talking about superstitions. That's it, Lance. We're done here.
Yeah, I even wore my Astros shirt last night, which was,
Throw it away.
I put it in the closet and I save it for special, like the world. I never wear it until it's like the World Series or like the, no.
Yep, you're going to have to put that one back up.
Yeah, it's super. And I even wore my lucky Astro socks.
Well, bring them back out in November, okay? Because we did not have that last night. There was not a whole lot of luck.
Yeah,
or bats.
But look, I'm rooting for them tonight. So, but I won't watch
tomorrow.
You know what I'll do tomorrow? Yes, I won't watch.
You won't watch?
I won't watch, and we'll see. And if they win, we'll know it's me.
It's you,
right?
It's gotta be. it is so funny though. Superstitions talk about that, and then people with the market and things in general, just how they invest, and there's so many of them out there, right? And sports is one of the most superstitious, especially baseball.
Yeah.
So just like you mentioned, kind of funny.
Socks, shoes,
Yeah.
hats.
Yeah. Oh, I have stuff that I've worn to Rockets playoff games that I will never wear again.
Really?
Yeah. And I don't know why. I'm not even superstitious. I'm like, nope, we lost.
I mean, yeah, it was interesting yesterday. There was the whole hubbub about the tweet from the Rockets manager, and now China has now basically said, "Hey, we're going to not do 2 games that were planned." And then one of the other managers yesterday tweeted out. He says, "Well, we support the Rockets' ability to have free speech. That's great. You don't have free speech in China."
Well, that was the commissioner of the NBA, Adam Silver, said that. So, Daryl Morey has this very controversial tweet, which, wow, people should have freedom. Imagine that. China gets mad.
Did they not know this is the whole thing with Hong Kong right now?
Yeah, exactly. So it's certainly an interesting dynamic. I was shocked that the NBA came out and supported Daryl Morey, to be honest with you, because Tillman Fertitta, there were rumors circling that he said, "Hey, this may be it for him." That they had serious conversations. Now, that's probably to save face.
Yeah.
I would imagine, but
Well, it's look. I think the whole thing has gotten. We've talked about this before, but and honestly, I think Russell's the smartest man on the planet because he still uses a clamshell phone. Right? He doesn't have all this Twitter, Facebook, social media nonsense. But it was just like yesterday we were talking. I think Brent, you and I were talking about this off the break. There's this young football player out in Katy. Had made a racial comment, and it was videoed, and it was put out, and he's now lost his A1 scholarship. Wow. He can't play games. He can't be team captain ever again, type thing. And he's like this up and coming star quarterback, playing varsity. I think he's either a sophomore, or junior, already playing varsity quarterback. But the problem with all this social media stuff is that it ruins people's lives. You make a mistake, right? And it never goes, you're never forgiven for it, right? And it plagues you for the rest of your life. And here's this kid. I mean, how many stupid things did you do as a kid?
Oh, man, plenty.
Yeah. And this kid's life is now ruined. This is going to follow him for the rest of his life. And his parents own a pizza joint out by our house. And, I don't know what's going to happen to that now. So it's just, but that's the whole problem with the social media. The stuff gets, it's like he makes a comment, as the manager of the Rockets, and then all of a sudden it's like, well, that may be the end of his career because you were trying to, be supportive of something, right?
Yeah, that's right. And this guy's an MIT grad. I mean, I think probably certified genius. I mean, it's amazing.
But that's what I'm saying, though. Just one thing. You just say one thing wrong, right? You post one thing wrong. It's amazing. So, we post every day stuff on Twitter. Stuff on Facebook.
Well, both.
And Twitter, true. But we don't have the problem with Twitter that we have with Facebook.
Right.
But we'll just post an article on Facebook about, why Trump needs a trade deal. And it gets blocked as a political post. It's marked as clickbait or a whole. I mean, you have to be so careful about everything that, and especially now with Facebook because they got so much trouble over Cambridge Analytics. Mm-hmm. You have to be uber careful. You basically have to say, this is a post about nothing. We're about to start the Seinfeld series.
Do that. This is a Seinfeld economics.
Exactly. A post about nothing, because that's about the only way it's going to pass their filter.
Well, you need to test these guys. So I wonder if you put that Trump will never get a trade deal done. I wonder if that goes through.
That's a good idea.
Hey, give it a shot.
Yeah.
Facebook, we're watching you.
Yeah, exactly. Yeah, we're watching you, and they're watching us. And
hey, but Russell's got to be the most mysterious man in the world if you think about it.
Why?
Well, because he has that clamshell phone. Nobody can track him. Nobody knows what he does. What does he actually do?
Dude, he's a certified genius. That's what I'm saying.
You got to stay off the grid, baby.
Hey, I hear you, man.
He's going to be the only one left alive when the zombies come. Because
right. Where's Russell?
It'll be like one of those new books, right? Where's Russell? I know what I'm buying for Christmas. I'm gonna give those red and white striped sweaters.
Oh man!
All right, look, we got work to do here this morning. Futures are pointing up this morning, thankfully, because China has now agreed to maybe do a partial trade deal. And as we were saying in the last break, this kind of opens up this opportunity, what we talked about last week. We've got that article out on our website. Get by there if you want to read up on what our thinking is about that and what we think it means for the market. And we covered that a lot over the last week. So if you missed any of the shows, just grab any of the shows over the last couple of days. We talked about it. But importantly, if you're employed and have a job, there's an important thing that's going on right now. It's called open enrollment. This is where you need to get signed up, make sure you've got the right benefits, make sure you're selecting the right choices, and what are the things people need to look out for here?
Well, I think there's so many missed opportunities here. Disability insurance is a big one. Life insurance. Everybody thinks they're protected, that's one thing that most people say. You know what? I'll take care of it later.
Right.
It's easy to push off, and because we're never going to die, right?
Right.
It's just like the will conversation.
Well, I'm not.
Well, of course you're not.
You won't let me.
We won't let you. That's right. You don't think we have shots of adrenaline waiting? What?
He's down.
Big one. So, but there's a lot of missed opportunities here, and I think this is something that you need to spend some time on. And not only that, but just health insurance. They change frequently, especially in this day and age. And we're seeing a lot of employers passing the buck to the employee these days, where you're having the high deductible health insurance plans. There could be missed opportunities with health savings accounts. Health savings accounts are different than flexible spending accounts that you can actually put funds in. It's going to grow. It's going to give you a triple tax benefit. The only investment account in the whole wide world that you put money in tax-free, the money grows tax-free, and use it for medical expenses, comes out tax-free.
Nice.
Where else are you going to find that?
No, but that's kind of an interesting point because, again, I know that when you go to sign up, there's so many choices, right? You got this, that, and you're kind of like, look, I just need health insurance. So you kind of just mark the thing but that's the most challenging part. Most people leave so much stuff on the table because it's so overwhelming that it's just hard to filter through all that stuff to get it done.
It is, and a lot of these things you do pay for it pre-tax. So there's some additional benefits in that aspect as well, that the funds aren't taxed. Now, some of these other ones you will. You're going to still pay tax on. So it doesn't have the biggest impact on your paycheck as many think. Because I know people think, oh man, an extra $100 or an extra $50, that could go a long way.
Right.
Well, you're right. But on the flip side, you need to take care of yourself. You need to take care of your family. And there's so many missed opportunities here. So, all of our clients, we're encouraging them right now to let's take a look, sit down, make sure that we are, taking advantage of everything that their employer has to offer. And this is a big aspect of your overall holistic financial well-being.
Well, and a lot of this has changed a lot too, because of the Affordable Care Act. Companies made a lot of changes and they've shelved off a lot more of the expenses to the employees. That's increased a lot of the expense run that employees have to come out of pocket for. So, a lot of employees are just kind of barely making ends meet anyway. And one of the things that we've seen, of course, is a big drop off in the number of people participating in 401k plans. And they go, I just need that money at home. The one thing that you need to understand is that money's coming out before you pay tax on it, right? So if you make $100 at your job and you put $10 into your 401k plan, the $90 you bring home, that's the only part getting taxed. So when you put money in your 401k plan, the actual net change to your paycheck is not that much.
It's not.
Because of the fact that those dollars are coming right off the top. It's not you're paying tax on them first and you're bringing home a lot less money. You'll be surprised that you can actually contribute to your 401k plan, put some money away for retirement, and still bring home about the same amount of money that you were living on anyway. It doesn't make a huge difference. And the problem is that just a lot of people, they don't understand how this works, and they wind up leaving, and putting themselves in a financial situation down the road because they're not making the right choices today.
Well, you're also leaving money on the table in the sense of that bonus, the match. I mean, that is an actual bonus that you're getting from your employer. And so you need to take advantage of that. Make sure that you're getting at least that part. And I'm going to throw a wrinkle in your plan. I'd go ahead and pay the taxes. I'd put it in a Roth. If you have the ability to invest in a Roth 401k, this is probably an ideal time to do so. I mean, if you look at what people are actually paying in taxes, their effective tax rates are 12, 13, 14%.
Yep.
For the majority of Americans, this is a great opportunity to go ahead and pay taxes now, because guess what? Taxes are going up, baby, and it's not going to be good.
True. Interesting survey out today talking about the real reason why American seniors won't retire. Kind of goes right along with this whole idea that we're just talking about. So when we come back, we'll pick up on that. We've also got a couple of classes coming up we'll let you know about. Don't go away.
Living it up in the city. I got tracks on, we safe for arm. Gotta kiss myself, I'm so pretty. I'm too wild, I'm down.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
And welcome back to the show. It's morning 6:33. A couple of things that we'll need to kind of talk about today. We've got a new article on our website this morning. It's very, very good. Michael Leibowitz wrote a piece this morning talking about the issues of millennials and markets. And we've talked about this before on the show, is that, there's a lot of advisors in the business today, giving financial advice. You see them on mainstream media, see them on Twitter, FinTwit, stock twits, and they're all telling you about what stocks to buy, what stocks to sell, what to do with your money, where to put your money, et cetera, what to invest in. And they've never been through a bear market. They've never seen one as an investor. They may have lived through it because of their age. They were living in a home with their parents, or maybe they were in college at the time we had the financial crisis, but they weren't actually managing money, giving advice, and helping others, helping people manage their financial futures during a bear market. All they've seen as the markets as over the course of the last 10 years is one that's been on jet fuel of monetary policy, with the lowest sustained rate of economic growth ever in history.
And Lance, let me tell you how important that is. I mean, I can remember back in 2007 and 2008 how many advisors, one, got out of the business. Mm-hmm. They didn't make it. It was such a crazy time. And to think of not having gone through that experience even personally, like, man, talk about, no sleep. Because you have clients losing money. It's terrible. People's, and you plan for this, right? We put these, we know these things are going to happen. It's inevitable. We plan for it in our financial planning software. But at the end of the day, to actually go through it shapes an advisor in a different way.
Oh, yeah. It changes. When you have to, and I've written about this before. The thing that changes you is when you've got to sit across the table. And thankfully, I've never had to do this. But when you sit across the table.
You've never lost money?
Not 50%.
Yeah. Okay.
But yeah, I've never had to sit across the table and say, I'm sorry we lost half your money. This is how we're going to get it back, right? Sure, we lost money in 2008. We were down about 8-9%. But, that's much more manageable. And we had just started an article yesterday talking about managing risk and why managing risk is so important. Because of exactly this. It's, when you experience the risk of loss to a large degree, it changes the way you think about money, investing, saving, planning, your family's future, what you're doing with your kids, your outlook for things. All of a sudden things become very real very quickly. And it's also why, though, too, and again, I was talking about this survey, it says the real reason why American seniors won't retire. Not surprisingly, 37% says can't afford to do it. Right? Because even though they've been, in a rip-roaring bull market for 10 years, a lot of them are just trying to play catch-up. There's a lot of people I know that are just now getting back to even from where they were in 2008. So, they've spent, 11 years almost just getting back to where they were 11 years ago. And now they're way off their financial goals for future. And I was looking, there's a guy emailed me a link yesterday, and he's like, hey, take a look at this financial risk profile questionnaire software we just came out with. Tell me what you think about it. And it took me about 2 seconds. I emailed him back, and I go, it's completely useless. And he's like, why? I said, because your software banks on 7.7% annual rates of return. And he goes, well, that's what the markets give you. I said, not every year. And that's what I said, you just went through a year. By the way, did you know that the Dow Jones Industrial Average, just an example, is lower than it was as of yesterday? We haven't opened yet today, but as of yesterday, it's 300 points lower than where it was a year ago from yesterday. So you spent a year, you're 300 points lower than you were a year ago, about 1.2% lower than you were a year ago. And if you were banking on 7.7% rate of return, there's a year of your financial plan that's kind of gone. And so you've got to figure out how to get that back into your plan. Either you work a year longer, or you have to get a higher rate of return, take on more risk. And these are all the things that lead to really bad outcomes for individuals. But this is the problem for people that have not been in the business and have gone through that. I've been through two major bear markets, the dot-com crash, 2007, 2008, 1987, been through it, seen what happens. And that's why our views on management and risk are very different. We don't chase benchmarks. We don't care about that. We build portfolios to generate financial outcomes, which is what the goal is of investing anyway, which is to achieve a personal financial outcome. But this is what, it's a lot of the people on CNBC, a lot of the people on Fox Business, they've never, and even if they are old enough to remember the 2007 and 8 financial crisis, these people in the media, the guys writing articles for Market Watch and CNBC, the Wall Street Journal, they're journalists. They don't manage money. They've never actually managed money. So all they're doing is regurgitating really a lot of what other people are saying who have not actually been through a bear market. So
well, it's a lot of the information that the big institutions will push because we know what do they want you to do. They want you to stay invested. Mm-hmm. And that's why buy and hold is such you can't time the market. Well, you're right. You can't time it on a day-to-day basis exactly when to get out and when to get back in.
Right.
But the market gives you, just like you write about every single day, it gives you some pretty good indicators to say, hey, it's a little bit risky here. Maybe we tone it back a bit.
Right.
And I think that's the important part. So you have a lot of these guys that are in there, never seen a bear market. Mm-hmm. They've been ingrained to say buy and hold. I get people who send me stuff all the time, and they say, what do you think about this fund or this portfolio? It is super aggressive. Right. Because they're doing it all on past returns, which is why every piece of paper will say, past returns is not future, indicative of what the future. Yeah. So it's going to ebb and flow. It's going to go up and down. We all know that, but we also need to take the precautionary measures when markets are expensive and heed what it's telling us at the moment.
Yeah. So what are some other reasons that Americans can't retire here? Can't afford, 37% it. 37% say I can't afford to retire. 23% say they're still supporting their family. In other words, they have millennials living at home. 19% say they're paying off debt. 13% say they're paying off their mortgage, and 4% says they're saving for a big expense. So that's why they're still working. But it's interesting. I'm still working to pay off my mortgage. You've got a mortgage that's probably about 4%. Don't worry about paying off your mortgage, right? That's cheap money. So there are times that leverage is good, and having a cheap mortgage is a good thing because a house is a dead asset. It actually is an expense. It's not actually an asset.
Yeah, but I think a lot of those people that were probably interviewed for that, they probably just have to have the income to pay their mortgage. That's the key, right? So we see a lot of people living above their means. This market's never going to crash. Easy money's always going to be there, and that's just the way people feel. Mm-hmm. And so, like you mentioned earlier, people aren't saving enough.
The other side of this is that what's the ideal age to retire? It used to be 64. It's now 72. Wow. So, but we're all living. You got to say that, right? I mean, you just said a minute ago, you're not going to let me retire. So
true.
So 72 maybe.
Well, but that's not from an economic standpoint. It's just because we're not going to let you.
See, but yeah, I mean, but we are living longer, right? We're healthier in some cases. If you've taken care of yourself, we are living longer. We have all these wonderful drugs that will keep you going longer. But our life expectancy is much better. Quality of life is better. We were talking yesterday with Daniel Lacow. We've got an awesome interview coming up next Tuesday with Daniel Lacow. He just wrote a great book on freedom or equality, talking about, the Democrats are promoting a lot of things right now about, free college and a lot of socialistic programs. And he's written a great book about what's really important is having freedom more important than having equality. But he's from Europe. He lives in Europe, he's a professor, an economist, has worked for major hedge funds, major universities in Europe. And great conversation yesterday about healthcare, right? And a lot of people talking about, we need a government-paid, single-payer healthcare program. That'll solve our healthcare problem in America. Everybody will have cheap insurance. He's like, no, you won't. He says, we have this in Europe. And in nowhere in Europe is your insurance cheaper. And everybody in Europe, if you can afford it, yes, you have a public option that you don't want to go to. Everybody in Europe, if you can afford it, has a private option of insurance. They buy private insurance. And when they get sick, what do? They fly to Houston, Texas to get treatment because we have the very best doctors in the world right here in Houston, Texas. People come here from all over the world. They pay 20% of the tab. The private insurance pays the other 80%, but they come here to get treated because our system provides the very best health care everywhere in the world.
Yeah, there's nowhere else in the world that kings and queens fly to on a regular basis to be treated, right?
Exactly.
I mean, you've got the prince of just about anywhere usually in Houston, Texas, for some type of treatment.
Exactly, and we should be proud of that in Houston. I mean, we do have a fantastic healthcare system in Houston.
Oh, we do. It's amazing. I mean, it's always. I guess it's always mind blowing to me when you drive by the medical center. It's just huge. It's like another downtown. It just gets bigger and bigger and bigger.
Absolutely. So, but yeah, so that's that interview, by the way, is going to be on next Tuesday. So if you go by our website, realinvestmentadvice.com, and click on our YouTube link, it'll ask you to subscribe. And then when we release the podcast next Tuesday, you'll automatically be notified of that. So you can actually see it. It's a great interview with Daniel Calvo, just eye-opening about the benefits of capitalism and what we have in America that, unfortunately, a lot of the young youth that's coming up, again, kind of the same thing with not understanding a bear market. They don't understand the benefit of what capitalism will give them in this chase for equality and wanting equality over freedom. And freedom is really what you want. The freedom to build, the freedom to invest, the freedom to build your life, the things that you want to do. That's the important thing, is freedom. Be right back after the break.
Trying to make ends meet. You're a slave to the money and you die.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Everybody get up!
And welcome back to the show. I'm your host, Lance Roberts. Danny Ratliff joining me this morning, 6:47. Got a class coming up, right?
We do. We're actually going to have Social Security for women coming up on the 16th. So next Wednesday, go by realinvestmentadvice.com, sign up. We're going to be talking about some of the pitfalls of taking Social Security too early, some of the penalties that can be associated with it. That really, those kind of fly under the radar quite a bit. So we're doing that on the 16th. And actually, we're doing our right lane workshop. It's going to be on the 19th in the Woodlands. So you can go by and sign up for both those at realinvestmentadvice.com. Go into the events tab. Love to have you guys out. Going to cover a ton of information.
Yeah, the right lane retirement class is our big class that we hold once a month. And this is the last one for the year because we're getting ready to, get the holiday season, and we've got parties and events and all that coming up. So this is the one class you really don't want to miss. Covers investing, Social Security, Medicare planning. I mean, just about everything that you need to know for retirement. So it's really the one class you don't want to miss, and that's on the 19th of the month in the Woodlands. So simply go by the website. Like you said, we have an events tab. They're right there on the front page as well. Just click on the event that you want, and it'll put you right into the calendar, and you can lock in your seat.
Yeah, we actually have people that show up multiple times. And they say, you know what, I learned something new every time, and just hearing the information again is always good.
They come for the food. Come on.
You're coming to the wrong place. Hey, you're lucky to get a cup of coffee, but yeah, we may have a donut or two, something like that. But.
It's like Thunderdome. It's one donut.
One donut a piece.
Oh, a piece. I just thought it was one donut.
It's not a bad idea.
A donut.
Hey, we're promoting good health.
Exactly. So anyway, this morning futures are pointing up a good bit. Of course, we had a big sell-off yesterday. The rally today likely not even to recover what was lost yesterday. Hopes that maybe there's going to be a trade deal, a partial trade deal. What we've been talking about for the last couple of weeks. That's really what's kind of moving the markets this morning. Of course, the potential, of course, now is the errant tweet. Over the next 24 to 48 hours, the question is who's going to blow up what and where, right? So that's going to be the big risk to investors. So the best thing to do right now is just kind of sit tight, don't do anything. We're actually looking to use this rally today or tomorrow, depending on how this is going, to actually trim some profits out of our portfolios. We've got a lot of positions that are, pushing all-time highs, and they've done really well since the beginning of the year. We've already taken profits earlier this year. We're looking to take profits again here because just positions are getting very, very extended. And just as we were talking about earlier about risk management, this is just a real key part of risk management, which is, to rebalance risk in portfolios by, trimming off some of your winners, getting rid of your losers, and balancing risk across your allocation model to weather the event that something goes wrong. It's always easy to add money back to a portfolio when markets are going up. It's hard to get out of risk or to manage risk when markets are declining. It makes it much more difficult. So you're always better off to, essentially, carry an umbrella in case it rains. right? And that's why you don't, if you wait till it rains to go get the umbrella, it's kind of too late, right? So that's the real point of what we're looking at to do here. But we'll keep you updated. If you go by our website, we'll keep you up what's going on. At RIA Pro, which is our subscriber-based version of our website, we actually give you real time what we're doing and when we do it. So we keep you fully up to date. We give you analysis every day, like our post today is on our actual position review of our portfolios about the positions we're going to be trimming. So that's at riapro.net. You can check that out free for 30 days, and hopefully it'll help you be a better investor.
Well, and a lot of these things right now at the market are based on trade negotiations, number one, and then the Fed coming out yesterday and basically saying but not saying that they're using quantitative easing as a tool in the toolkit, right?
Right. Well, and again, it was interesting because yesterday, Jerome Powell, what Danny's referring to, Jerome Powell came out yesterday and talked about expanding the balance sheet. We're still having these issues. We talked about on the show about repo. It's complicated. Don't worry about it. But basically, there's a funding problem between banks, and the Federal Reserve has been having to step in to provide liquidity for banks to execute transactions between each other. Now, these are fully collateralized transactions, overnight loans. It's very short-term money. Yesterday, Jerome Powell made the announcement that they're going to be talking about expanding the balance sheet a bit to help increase reserves to a degree to help solve some of these short-term funding problems. But he says, don't mistake this. This is not QE that we were doing previously. Immediately, everybody on the internet jumped online and says, oh, no, it's QE because they're expanding the balance sheet. It's really not QE. The difference is with real QE is that they were long-term asset purchases. These were bonds they were buying and holding on their books, and that's why their balance sheet expanded. This is short-term money. They're going to temporarily expand the balance sheet until the funding problem is issued, and then they'll let the bonds roll back off again.
But when you refer to this as short-term money, you mean like really short-term money?
It's short-term. It may be a month. It might be 2 months. It might be 3 months. But it's not going to be a permanent increase to the balance sheet. And that's why he was saying don't confuse this with QE. It's not the same thing where they were injecting liquidity into the financial markets to help heal up the banks. This is simply solving an overnight funding process.
So why do they have to solve this problem to begin with, right? Where's the disconnect or the breakdown in this?
Well, so this goes back to what repo is. We've actually written an article on this. We don't have time to get into the nitty gritty of it this morning, but we have an article on our website talking about repo. So if you just go to the search bar and put in REPO, repo, the article will come up. We explain what repo is and why it's important. In a nutshell, banks loan money to other banks overnight if they have a funding problem. So in other words, they've got a big outflow of cash and they need to borrow money to meet that obligation. Because remember, our banks work on what's called fractional reserve banking. In other words, you have money in the savings account right now. So you may have a CD at the bank. You may have a savings account at the bank. You may have a checking account at the bank. There is no money in your account. That money is gone, right? You have a digital balance with the bank. Your money has been used for the bank's activities, whether it's loaning money to other people, meeting other people's demands on needs for cash, etc. There's not a cash box sitting around with your money sitting in it waiting for you to come get it, right? And so banks can leverage that money 3, 4, 5, 10 times to 1, whatever it is. That's why so they have to hold a fraction. That's why it's called fractional reserve banking. They hold a fraction of their money in-house. The rest of it is all out in the ether. So the problem is if they have a big demand for capital, they don't necessarily have that cash on hand to meet that demand. So if somebody comes and says, hey, I need $1 billion tomorrow to meet a tax payment or whatever it is, they don't have that. So they've got to go out to other banks and say, I'm Bank A and Danny's Bank B. I go to Danny and say, Danny, I need $1 billion overnight so I can meet this cash withdrawal. And Danny says, okay, I'll loan it to you. And typically I loan it to you at the Fed funds rate. So, 1%, 2%, whatever it is. All of a sudden, I'm going to Danny and Danny's saying, yeah, I'll loan you the money, 8%. But wait, I'm giving you, and in order for me to borrow the money from Danny, I have to give Danny, think about it this way. I've got a Mercedes AMG sitting in my driveway, right? $100,000 car. I'm going to Danny and I'm going to borrow $10,000 from Danny. I say, Danny, I'm going to give you my car as collateral. Now, Danny says, great, I'll take your car as collateral. Now, you'd say, when he's holding a $100,000 car or more for a $10,000 loan, he should loan that to me at the lowest interest rate, right? He's fully collateralized. But Danny says, no, I'll hold your car. I'll loan it to you at 8% interest. Not 2. I'm going to loan it to you at 8. That's what's going on because these banks put up treasuries as collateral. These are fully collateralized overnight loans. And Danny's going, I'll loan it to you at 8%. That tells you there is a problem within the financial system itself. There's too much demand for capital, not enough liquidity. And banks are basically taking the opportunity saying, yeah, I'll loan it to you, but it's going to be 8%, 6%, 5%, whatever it is. But it's substantially above what the Fed funds rate is. And that's why the Fed's having to step in to provide that liquidity at market rates.
Well, is this also an indicator, though, that maybe some of these institutions aren't as healthy as what they
Exactly.
seem?
That's exactly the point. That's what I'm saying is that there's a problem somewhere in the bank. We don't know what it is yet. And we're likely to find out about it down the road that there was one or two banks maybe on the brink of potentially going out of business. We'll find out who it is later, but it's probably a big bank. Now, I'm not saying it's JP Morgan or Citibank, but it's probably a fairly large regional bank that's maybe at risk. Could be even a foreign bank that's at risk. Deutsche Bank, Commerce Bank, could be numerous institutions.
Well, and they're all intertwined now, so the overall impact is it's probably the threat of contagion more than anything, right?
Correct. Yeah, I mean, look, you've got we've got a tremendous amount of corporate debt that's on the verge of going junk rated. We've got a lot of energy loans that make up the junk rated bond world that are on the verge of going bankrupt. You have a tremendous amount of other auto loan debt that is subprime. You've got mortgage debt that's subprime. So, I mean, you've got a lot of debt out there that's on the verge of being hit. So, and this is one of the big things, right? If interest rates go up by any marginal degree, 2.5%, you're going to run into problems economically. So, again, the markets just can't stand higher rates. And the Fed's got to be very careful here because if the Fed does do QE raises interest rates. Every time the Fed's engaged in doing quantitative easing, interest rates go up. And when interest rates go up, you run into economic problems. And every spike in rates has been the peak in the interest rate during QE is lower than the trough of the interest rate prior to when they started QE the last time. So it's a consistent drive to lower rates.
Which is probably why Trump's saying lower rates, not provide QE, right?
Yeah.
Because he wants these rates as low as possible.
Correct. And you're not going to get that if you do QE. So, but he wants both. He thinks that he wants low rates and QE. He thinks the banks should do Trump believes that we should do exactly what Europe is doing in terms of lowering rates, negative rates, quantitative easing. And what he misses is that those programs in Europe have destroyed the European central banking system. The banking system in Europe has been destroyed by negative rates and excess monetary policy. And same thing in Japan. Japan's got the same exact issue right now. But that's what we're lobbying for here in the United States is because we think that low interest rates and quantitative easing is going to make the markets go up, which is great because that supports about 2% of the economy. It actually winds up destroying the mass majority of Americans because they can't get a return on their savings. They can't increase productivity, et cetera, because low interest rates don't encourage that. So that's the problem.
So this is just a one bad cycle that it seems like it's just on a continuous loop. And it's not going to matter if you're Democrat, Republican, like everybody thinks, because nobody wants to face this issue.
No, exactly. Just like we don't want to face the debt issue. And by the way, our debt, good news, is not going up because once again, we're at a debt ceiling limit and we haven't solved our funding crisis. So we have that to deal with as well. All right, got to wrap up the show for today. Danny Ratliff, Certified Financial Planner. Get by the website. Get signed up for upcoming events. They're on the website, realinvestmentadvice.com. Go to the latest blog post, our newsletter. Most importantly, click the YouTube link, subscribe to our YouTube channel, and we'll have that interview with Daniel LeCow next Tuesday on freedom or quality. But we have one out yesterday from Jeff Tinnery on moonlighting and the new future of employment in America. It's on the website now, realinvestmentadvice.com. Have a great day. Chris Salcedo coming right up.
It's a rich man's world.